Billionaire hedge fund investing legend is giving us an urgent warning about shocking tax increases and capital controls. Now, he's the same person that's been pounding the table telling us that cash is trash, and now he's telling investors to avoid the largest asset category altogether. So in this video, I'm going to explain what billionaire Ray Dalio, one of the world's most successful investors, is warning us right now. We're going to look at the warnings that he's giving us, what they mean to us and our portfolios, and what assets and investments we need to pivot into to survive this new future, or what he calls the new paradigm. All right, he's warning us, and now is the time for us to pay attention. So let's go. Okay, real quick, before we dig in, if you're new to the channel, my name is Mark Moss, and I make these videos because I want to change the way you think about money, because almost everything you've learned is completely wrong. And if you can learn to see and think about this differently, then you can have more freedom, more options for your life, your family, and your future. Now, if you like those topics and want to help me get them to more people, take one quick second, just click on that like button, hit the subscribe button and the bell notification so you're notified every time I put new videos out. That way more people see these videos, all right? Now, so today we are looking at an urgent warning from Ray Dalio. He's a billionaire hedge fund investor from Bridgewater Capital, and he's giving us some new warnings, and we should be paying attention. Now, if you've been paying attention, then what I'm going to say shouldn't come as too much of a shocker, but unfortunately, many people still don't see it coming. And even for those that do, they don't know what to do about it. All right, so we're going to talk about that. Okay, so I think it's been pretty obvious to everybody by now that the world we are going into is not the same as the one that we're leaving behind. Now, I've said that before, but it bears to be repeated, right? Everything has changed. The way that we work has changed. Now everybody works from home, right? Or maybe don't even have a job at all. The way that we travel has completely changed. The way that we interact with people has completely changed. And of course, what we're talking about now is the way that we need to invest our money has completely changed. Whatever has worked in the past is not going to be the same in the future. And of course, that's what Ray Dalio was talking about. So it's obvious to see that as a response to the pandemic, maybe not a response, maybe it was under the excuse of the pandemic, we saw just last year in 2020, the Federal Reserve created more money. They printed over 20% of the money supply in one single year, added 20% of the money supply. And their bond buying programs, their credit default swaps, all these things, they've been manipulating the markets like we've never seen before, propping stocks up, propping assets up. And so what this means is that all the old investing models that we have, and your financial advisor shows you the history of things like that, all those old investing models that might have worked in the past for decades, they need to be thrown away. They're completely wrong. They need to be thrown out the window. Those old models are now completely worthless. Now, Ray Dalio has been super loud. He's been a very outspoken critic of the US dollar for quite some time now. If you've been watching my video, I've been talking about the decline of the dollar as well, because it's inevitable, right? You can't just print 20% of the money supply in a single year and have the dollar hold up. And so Ray Dalio has been saying the same thing. Like I said, he's been pounding the table saying that cash is trash. But now he's doubling down on that. Now he's telling us, quote, "I believe that cash is and will continue to be trash," of course, continuing to say that, which what he means basically by that is that he thinks that cash or US dollars is a horrible place to put your money. He says that it will continue to lose its purchasing power because of the massive inflation and the massive devaluation that's coming. Not only is it coming, it's here right now. All right. Now, on top of the warning on cash, now he's also warning us about bonds. Now, bonds has been typically a safe place, and he says that now, quote, "The economics of investing in bonds and most financial assets has become stupid." That's his quote, not mine. "Investing in bonds and most financial assets has become stupid." He went on to say that rather than get paid less than inflation, why not instead buy stuff, any stuff, that will equal inflation or better? Wow, that's some pretty big words from Ray Dalio. It's stupid to buy bonds or financial assets. Why not just go buy stuff? Any stuff, that's what he said, that will equal inflation or better. So of course, I've been talking about this quite a bit. As they continue to print an unlimited amount of fake fiat currency, it's going to drive people to go buy real things. As he says, go buy stuff, any stuff that will equal inflation or better. Now, Dalio thinks that it may even be a good time to borrow cash to buy higher returning non-debt investment assets in what he calls the new paradigm. And he says it's characterized, this new paradigm is going to be, ready for it, unfortunately, shocking tax increases, and even prohibitions against capital movements. So, of course, as the empire declines, as debt continues to go up, it gets harder and harder for people to survive. That means less income, that means less taxes. And what does the government do in response to that? Well, of course, less taxes mean they need more money, so they have to increase taxes. He calls it a shocking tax increase. But even, this is more scary, what he says, prohibitions against capital movements. So now, you can't get out of the dollar. You can't get out of bonds. You're forced to take your pension and put it into bonds, right? So that's what he's talking about, like controlling the capital by telling you what you have to do with your money, what you can and you can't do with your money. Now, he's talking about taking your cash, which is losing value, and then buying higher returning non-debt investment assets. Now, I have been on the other side of this. I've often said, and I've been asked this numerous times, should I borrow money to invest? Should I borrow money out of my house? Things like that. Typically, the rule with investing is you never invest what you can't afford to lose. So I've always thought that borrowing money is a horrible thing to do as far as investments. Now, of course, there is such thing as good and bad debt. So debt that you leveraged to do certain things can be worth it. But he's saying you should probably do it. Right? That's what he's coming out and saying right now. Now, we're seeing, of course, like I said, rising amounts of government debt and what he calls classic bubble dynamics. All right. Now, he's saying that we're seeing that among many different asset classes. And so Ray Dalio is recommending to investors to look to hold what he calls non-debt and non-dollar assets. So what are these, right? What are these non-debt and what are non-dollar assets? So let me dig in right here and explain this to you. So the non-dollar assets, I mean, that's pretty easy, right? He said the cash is trash. He said it's going to lose massive purchasing power to inflation. So we don't want to hold cash. We don't want dollars, right? We don't want assets that are pegged to dollars. So we don't want to get stuck, we don't want to have too much exposure to dollars. But what are the non-debt assets that he's talking about? All right. So the non-dollar assets, like I said, that's easy. Cash is trash. Stay away from those. But the non-debt assets, most people are holding those. So most investors have, probably some money in a 401k, an IRA, some mutual funds, some other form of investments. Hopefully, anyway. Hopefully, you're saving for your retirement. But these are these funds that you might be in are typically run by financial advisors or some type of a firm. Maybe your employer sets you up with, right? And this advisor probably has you in something called a 60-40 split portfolio. It's the most popular setup. So what that means is that 60% of your money is in stocks, and that's for growth, and then 40% of your money is in bonds, and that's typically done for income, and that's to offset the stocks. Now, the 60-40 portfolio has worked really good over the past 40 years. So your financial advisor is going to sit you down and go, look what it's done over the last 80 years. Over the last 40 years, it's worked really good. And that's because the correlation between stocks and bonds has typically been, it's generally remained pretty low. And so what that does, if the correlation is low, meaning they move opposite of each other, it helps to reduce volatility. So if stocks go down, bonds do good. If stocks go up, and it manages that, right? So over that period, it's done really well. But as I said, the world we're going into is not the one that we're leaving behind. So unfortunately, the 60-40 portfolio, it's not going to work moving forward. As a matter of fact, it hasn't always worked. As you can see from the chart that I have up on the screen right now, this chart shows the correlations within the 60-40 portfolio going all the way back to 1883. All right, now as you can see, there's been long periods during which stocks and bonds were highly correlated. That means they were moving together at the same time. And so this eliminates the diversification benefits of even being in the 60-40 portfolio at all. All right, now the reason why they would show you that it has been working good is because bonds have typically paid pretty good. Bonds are cash flow. Bonds are debt, right? So that's what he's saying, debt-based assets. So when you buy bonds, you're basically buying someone's debt. And of course, when you loan money to someone, they pay you back with interest, which is good. That's cash flow. So if we look back 40 years ago, bonds were paying as much as 15% to hold them, which is amazing. You can't find 15% anywhere anymore, but they were paying that much. And when we look at the period just from like 1976 till 2019, so the period your financial advisor is probably going to show you, they've averaged an annual return of 7.5%, which is exactly why most pension funds and Social Security funds and your financial advisor show you that, oh, you should average 7%, all right? 76 to 2019, it's done that, right? That's great, but it's not anymore, all right? And that's the thing. Like I said, the world we're going into is not the same, and it is not paying that anymore. So for those of you that don't understand what bonds are, let me just break it down just real quick. I'm going to give you a quick overview. So basically when a government or a corporation, when they want to take on debt, they issue a bond, right? And then that bond has a yield, right? The yield is the rate of interest that they're going to pay you to buy that debt, to hold that debt, basically to loan the money. All right, now just like everything else, all financial economics boils down to one very simple rule, which is of course supply and demand. So if there's lots of investors willing to buy the debt, then the yield goes down. And if there's not enough buyers, then of course the yield goes up. So let me give you an example of how this works. So let's say for simplicity reasons that you have a 1-year bond. So you're going to buy that debt, it's 1-year term. All right, and it's trading at $97 and it has a par value of 100. So what this means is that you can buy $100 in the future for $97 today, which is pretty good, right? So that means that you'll basically earn $3 or 3% for waiting a year until that bond matures. But let's say that there's too many buyers for this kind of bond, right? And everyone's scrambling to find some yield. We can't get 7% anymore. All these portfolios were set up for 7%. All these pension funds and hedge funds, or pension funds and Social Security funds and individual investors, they all need yield. They're all looking for that return and they can't find it. All right, so they're all scrambling to get that. So there are too many buyers now. So let's say that the bond price increases from say 97 to 99, right? They bid it up. Well, what that means now is that you're buying $100 of the future, still value, but instead of 97, now you're paying 99 for it. You got bid up. So now what that means is you only make $1, or you're making 1% for buying this bond. All right. Now remember, I said that from 1976 to 2019, bonds had a yield, an average annual return of 7.5%. Well, today, the U.S. Treasury's 10-year bond, which is kind of the benchmark bond, that's the one that people look at the most, it's only about 1.5%, all right? This is nowhere near the average 7.5%. And of course, what does the future hold? Well, it's pretty easy to see, right? With the government's increasing debt, it's now surpassed $28 trillion. No one's expecting the rates to go up anytime soon. In fact, they probably never will. I mean, how can they? How can they raise rates on $28 trillion of debt, and they are going to continue to increase that debt more and more and more? I mean, just this year, we're 3 months into this year of 2021, and here they've already gone 900 billion, 1.9 trillion in stimulus. They're already talking about 3 to 4 trillion more, probably 10 trillion by the end of the year. How can they raise rates? So do you see rates going up? I don't, and they probably won't. They probably never will, and that's because they can't. So what do we do? What do investors do? All right, well, institutions, hedge funds, corporations, they're all trying to figure this out as well, right? They all have their pension funds that they have to pay out. So they're trying to figure out, where can we get that yield? What are we going to do? The 60-40 is dead, and they know it. So they're all trying to find a new asset category that shows low correlation to stocks, all right, and more importantly, has a very good risk to reward setup, a good risk to reward ratio. And so they're trying to do this, and they are trying to do it fast, as in like right now, because the Fed, like I said, is printing trillions of dollars. 1.9 trillion just left the printers. It's just hitting the streets right now. And like I said, they're already talking about another 3 to 4 trillion coming out next. And so this is why Ray Dalio is warning us about what he's calling, right, the shocking tax increases and, again, prohibitions against capital improvements. So with all this information, what are the most successful, what are the most cutting edge billionaires, hedge fund managers, S&P 500 corporations? What are they doing about this? What are they pivoting into if bonds are dead? As Dalio said, Dalio said that they're stupid. So what are they pivoting into? Well, they are going heavy into a brand new asset class. As a matter of fact, JP Morgan, the largest bank in the United States, has just started to pivot into this after in 2017, JP Morgan CEO Jamie Dimon called it a scam. He called it a fraud. And now today, they're recommending to their investors to open up at least a 1% portfolio allocation to this. All right. And if you've guessed ahead, then yes, I am talking about Bitcoin. All right. Now, before you roll your eyes and tune out, just hear me out on this. All right. We have Kathy Wood, who leads ARK. It's one of the most successful funds on Wall Street. And she thinks that corporations will move as much as 10% of their corporate treasuries into Bitcoin. We've already seen Square, one of the fastest growing payment application softwares out there, they hold 5% of their cash in Bitcoin. We have Jim Cramer from Mad Money on TV. He's recommending a 5% allocation to it. We have Mr. Wonderful from TV's hit show Shark Tank. I'm talking about Mr. Kevin O'Leary, and he's been super negative on Bitcoin in the past, over and over talking about it, and now he's changed his mind. He said that he's allocating 3% of his portfolio to Bitcoin, and more importantly, he said that every single one of the companies that he works with, which is a lot of companies through all the years of Shark Tank, he said that every single one of them wants to put at least 3 to 5% into Bitcoin. We have billionaire hedge fund manager Paul Tudor Jones. He's allocated 2% of his portfolio to Bitcoin. He says he wants to do more. Big news came out. Tesla bought $1.5 billion of it for its corporate treasury. We have billion-dollar software intelligence company MicroStrategy. They put their entire treasury into it, right? They put almost $500 million into it. It's now billions of dollars, and they're still buying today, even at these record high prices. And then the biggest news just came out, rocked the world. Morgan Stanley, one of the biggest asset management companies in the United States, just announced that they are now advising and selling it to their clients. All right, so you get the point here, right? As Ray Dalio said, cash is trash. And now he said that bonds are dead. Bonds are stupid. That's what he said. So what that means is that the 60-40 portfolio is completely dead. And if your financial advisor is still recommending that you have a 60-40 portfolio, then you need to consider getting a new financial advisor. Now, I said before, right? I've said it over and over on this video and before that the world's changed, right? The world has changed. The Federal Reserve, the central banks, and the world, they've broken the markets. The past is no longer relevant for where we're going anymore. At the rate that the feds are blowing up the currency, as Dalio puts it, we're going to see massive inflation and people are scrambling to get out. Now, when we look back through history, all right, we can see that when currencies melt down, we typically see other sound currencies that investors can rush into, like lifeboats to get in. But this time, all the governments of the world, all the central banks of the world are printing at the exact same time, and all fiat currency systems are losing value at the same time. So where are investors going to go? They can't go to other currencies. They certainly can't go to bonds. Half of the bonds are paying negative yielding, means they actually take money from you to hold them, right? So where are you going to go if you're looking to preserve your wealth? Now, I've built my career on a simple principle that success leaves clues. And what that means is that if you want the shortcut to success, then you find someone who's successful and you do the same things that they're doing. In this case, as I said, the smartest hedge fund managers, Fortune 500 CEOs, and other analysts are all leaving bonds. Bonds are stupid, and they're diversifying their portfolios with Bitcoin. Now, this doesn't mean that you have to be all in, all right? I'm not talking about that. You don't have to put 100% of your assets into it. As many of these people have done, you could put 1 to 3%, all right? Right? That's what they're doing. Now, if you lost 1% of your net worth, or if 1% of your net worth went down in half, or you lost it all, it's not really going to matter much, right? But if it goes up 5, 10, 30, 50 times like Bitcoin can, then that would be a pretty big deal for you. And that is why they're diversifying. Now, it's going to help you at least offset the coming inflation that's already here, that we're already seeing it, and it's only going to start accelerating. But the thing is, you have to get there before it does, right? So I'm going to leave you with this. I'm going to leave you with the words from Satoshi Nakamoto, and he said that, quote, "It might make sense to just get some in case it catches on." So let me know what you think. Do you think that Bitcoin will be a part of a diversified portfolio in the future? And if so, how much? How much do you think you should put in? 1%, 3%, 20%? Let me know. One other thing I want to add. I'm going to start doing a new video each week where I'm going to answer questions on a video. So leave me actual questions. I love your comments, but if you want to leave me questions, I'm going to pick the top questions and I am going to answer them on my new Market Disruptors YouTube channel every week that I'm doing. So leave a comment down below, and in the description, look for my new channel, Market Disruptors, and I will be answering the questions on that video. If I pick your questions, I am going to send you $25 in Bitcoin for presenting the question, and I will be answering it there. All right, so that's it. Give me a thumbs up on this video if you like it. If you don't like the video, give me a thumbs down. Either way, I want to hear from you. Leave me a comment, and of course, ask me your questions. I'm going to answer those on my new channel. Link is in the description. All right, that's what I got for you today. To your success, I'm out.